Hello there and welcome to Oil Market Insight. You're joining us here in Vienna at the OPEC headquarters on the occasion of the 171st OPEC conference. Thanks so much for being with us, and we're going to take a look now at the state of the oil market. I'd like to start with you, if I could, Jason, when we look at the state of the global economy, the health of the global economy, ultimately what's going to determine oil demand. Bring us up to date on how are things looking right now in your book?
Well, I'd say that generally things have improved, and especially we've seen the second half of the year has been quite good. The Chinese manufacturing PMI, the Eurozone manufacturing PMI, the U.S. ISM manufacturing index, all of these are leading indicators of growth. They strengthened in the second half of the year. So whether we're talking about China or the Eurozone or the United States, things are better in the second half of the year, much better in some cases than they were in the first half of the year. So this is positive for oil demand growth as we go into 2017. We have kind of some mixed outlooks, but generally see growth remaining around 3% for the global economy in 17, but significantly stronger in 2018.
And again, that's exactly what the market needs to drive that growth. When we look at the work that's been going on, particularly coming out of the OPEC Secretariat in the last few months, Jason, there's been a huge drive since the Algiers Agreement to really get consensus in the market. And again, much more aggressive than we've seen before here, bringing OPEC and non-OPEC together. How important is it that we really begin to see this cooperation and this development to go forward to really help drive the market and help, move the agenda, so to speak?
Well, I think we've seen a big change under Secretary General Barkindo in general, where there's a move towards more what central bankers would call forward guidance, right? And this is where you're providing more information to the market. There's the frequency of press releases, the frequency of shared information, all of that has gone up in order to be, at least as I see it, more transparent with the market, to share more information about discussions. But by the same token, because there's been more frequent discussion of things following the Algiers Accord and discussions between OPEC and non-OPEC members, it does raise the stakes a bit in terms of, when, how, could there be an agreement? What does that look like? But I think that this forward guidance does seem to be an effective policy. And like I say, as OPEC is the central bank of oil, this is something that other central banks do very frequently, and it's a highly effective means to help the markets kind of understand what's going on and what could potentially happen next.
When we look particularly at the shale players in America too, and again, let's take a quick look at the global or the American economy, Jason, perhaps. There's been a big shift, obviously, in policy and politics in the US too, and we'll have to see how that plays out. But, what is the situation for domestic production in America right now?
Well, I think there's a couple things. Obviously, the current price level is less conducive to drilling than it had been. I would say, though, that it's still relatively easy to bring some of those shale supplies online. But again, they're very small compared to the conventional finds that are out there in the marketplace. I'd say that the biggest thing right now that's a challenge is that there had been a mandate, and there still is a mandate on the books from the Fed, the FDIC, and the OCC, which are the bank regulators in the United States, to really restrict lending into oil and gas in the U.S. So there is a mandated by the Fed credit crunch for oil and gas drillers. So unless you have a lot of cash, your cost of capital has gone up many times over, because you've had to go now, instead of going to the public markets where you would have, or banks where you would have gotten a 5% interest rate on money you didn't have, now you might have to go to private equity and get 25%. So your cost of capital has gone up a lot. So this makes players with lower grades of credit or less access to cash, they're in a more challenging situation, and they're likely to remain there probably for another year or so.
Let's take a look Jason, at the political landscape. I mean, we've got a new president in place. How good will this be for the oil market? Surely he'll be pushing all sorts of activity.
Well, I think it's going to be a mixed bag, because right now, if we look at the fiscal policies that have been proposed, what you'd expect is more deficit spending, which is likely to lead to more growth. You're also going to get tax cuts, which leads to more growth, and all of that more growth leads to more inflation. So that additional inflation could also be supportive for oil prices, right? So if you get more growth, you get more inflation, it pushes up your oil prices. Now, by the same token, the back end of the yield curve, so longer dated Treasury rates, there's been a sell-off in that bond market. You've seen those rates, the interest rates go up at the back of the curve. And that means that if you get more deficit spending, right, you have to finance it with more debt, you could see interest rates go up. And that could, again, continue to pose a challenge from a cost of capital standpoint for drillers, but the price of oil could find support from the inflation and growth.
Has this been a bit of a wake-up call to the industry, would you say so, Jason, in terms of the fact that, and I've done so many conferences, no doubt you've done them yourself, and it really is becoming the mantra. Somebody recently was talking about fit at 50, while somebody said we might, see fit at 50, but we might never be happy at 100 again, and that's almost the reality. But, has it really woken the market up to see and prove to themselves they can be a lot more efficient and produce better?
Well, I think there's two things. There's the OPEC side, which is the operating costs. So those have fallen, and some of that is, now it's more, if you're a driller, it's a buyer's market, right? So you can pressure some of your vendors, and now, you might have a better profit margin. But again, if you're financing that with debt, your cost of capital went up 400%. So unless you had an 80% drop in your drilling costs, if you're borrowing money, it's still more expensive for you to get those marginal wells. So I think that's one thing. I think as we look at a wake-up call, I think, there's always in places like Houston and Texas, and as there are in OPEC countries, there's always a concern that a drop in oil prices can have a negative impact on the economy, can cause a slowing of growth. And I think everyone's already well aware of that. But the underinvestment, that massive pullback that you just alluded to, rolling into a third year of this, presents significant upside price risks to oil when we look out 3 to 5 years.
Jason, and that volatility, how harmful do you think it is at the moment, or is it? It's just part and parcel of what we have to live with.
Yeah, I think it's part and parcel of what we have to live with. I mean, to be honest, the biggest swing in prices was when, we saw the price was low in the first quarter of the year, and it trended up through the summer, and then, you began to see a sell-off in July. And since then, we've been really choppy. It's been almost a relatively sideways movement rather than the significant trending we saw early in the year. And so, how we define volatility might be the question, but I think we're going to see choppy trading for a while. I think, no matter what happens, at this meeting, I think we're going to see some choppy trading. I think that, ahead of the summer driving season in the U.S., it's going to be choppy. But once the refineries come in at the end of February and they're buying the NYMEX contract rolls and they're buying crude oil for the summer driving season in the U.S., that should be supportive moving forward. And if that happens in a time period where the global economy, continues to, grow modestly, then that's going to likely prove supportive, especially at a period of high demand.
So, Jason, for 2017, is it all about the economy?
Well, I think it generally, for oil, normally is. There's two things I've been telling my clients for years. And one is that the purchasing manager indices for manufacturing in the U.S., the Eurozone, and China, combined, those are a really good leading indicator of price. And they've improved a lot in recent months. The second thing that I've seen over the last couple of years is that industrial metals prices have been leading oil prices. At times in the past, it was the other way around, but right now, metals have been leading oil, and they've been moving quite a bit higher. I think that's a good proxy for what's going on in China, and I think Chinese manufacturing is a good proxy for the global economy. And if you're beginning to see some improvements in warming there, regardless of what happens in the OECD, maybe in the first half of next year, I think you're going to see that emerging market demand be strong, emerging market demand improve, and oil demand growth rise.
So indeed, still a lot of challenges, but it's a new challenge every day in this market. So thank you again for sharing your insight and expertise with us. We really appreciate it. And that wraps up this edition of Oil Market Insight. A big thanks to Bill, Jason and Gaurav. Thank you so much for joining us. And stay with us, of course, on the OPEC website, where we'll be bringing you up-to-date news and views of what's going on in the oil market, and of course, full coverage of the 171st OPEC conference. Thank you.